two quality stocks trading at fair value. I don't do those very often, but I'm going to discuss two stocks that I believe are a quality companies and they're trading at fair value. A lot of you believe that I'm this deep value investor that believes Apple should be trading at 10 times earnings, and I just hate quality stocks or I hate quality investing. This is not true. I don't hate quality stocks. I'm just against overpaying for quality. I'm against just paying up just because a company is a quality company. And I personally believe in the market right now, we have a lot of overvaluation around quality stocks, and most investors are now quality investors, which would tell me that we have a lot of optimism around this area, causing a lot of investors to overpay. I mean, I shared something on Twitter. I said, would you rather buy Visa, amazing company Visa, at 25 times earnings, or Costco at 50 times earnings? And I just believe there's a massive overvaluations in general in the quality names. And then people look at Costco, they saying, quality is worth infinity. So then they overpay for other stocks, and that was going to lead to disappointment. So that's my problem with quality investing right now. But I'm going to share the first one. The first one is Visa. It may surprise a lot of you. You might believe, Visa is just extremely overvalued. I don't think so. I'm going to tell you why in this video. Visa is down pretty close to 6% from all-time high, and it's around 3% on the month. I've always been a big fan of Visa, of the business model, and the company in general. Pretty amazing company. Most of you know how Visa makes money, and MasterCard and all these names. They have many different revenue sources, but the main one and the most popular one is mainly transaction fees. So they take a percentage on the transaction. They mainly charge it to the business. Visa is between 1.4 to 2.5. Same with MasterCard, very similar. American Express is the most expensive one, of course. And if I looked at the latest annual report and I look at the total volume, Visa as of 2022, now it's like 15 trillion, but as of 2022, Visa is $14 trillion in volume. Just absolutely stunning. MasterCard is catching up, 8.1 trillion. But MasterCard is growing rapidly, but Visa is still king at $14 trillion. American Express is $1.5 trillion. Then you have Discovery and others like 258 billion and 320 billion. But Visa is still king at $14 trillion. Pretty amazing. And even though this company is, a little bit more mature, you could say it's a $500 billion company, the company is actually still growing. It's still growing double digits. As of the last quarter, revenue grew 10%. Net income grew 10%. Earnings per share grew 12%. So even though this is a $500 billion company, it's still growing double digits. It's just absolutely amazing for Visa. Of course, this has been slowing down a little bit in terms of payment volume. It's due to many different things. I personally believe it's mainly due to some of the things with the economy. We don't have the best economy right now, and just people just cannot afford the stuff they used to be able to afford. Look at Nike stock, look at Nike's earnings. Look at McDonald's. They're introducing a $5 meal. People can't afford the $10 meal. So things are not as good as they used to be. And of course, Visa is going to start to face some of those problems. This is the first reason. The second reason, which a lot of bearish people highlighted, is we're having more and more competition. We're having competition maybe from buy now, pay later. This is getting very popular in the United States. A lot of people, when they check out online, they're using buy now, pay later, maybe from PayPal, or they're using it from Affirm or from Klarna, I believe it is. And there's so many players in the space. Buy now, pay later is one. Another one is crypto, and some of them, they use crypto for transactions. Now, I'm not really an expert in crypto. I don't really understand it very well to know what Visa's edge in it or if they have anything. But I heard a lot of people say that Visa missed the boat on it, and they're trying to catch up some solutions and capabilities and all kind of things with crypto. Now, I'm not sure how this is going to happen or what kind of things Visa could do, but crypto is another one where people use cryptos. They use buy now, pay later. They use maybe PayPal. They use other things, and it's affecting Visa a little bit. And I see it. I mean, that's true. But if I look at where Visa is trading at right now, it's trading at 25 times earnings, which has historically been a good time to be buying Visa. If you look at this line I'm showing you, historically, it has been a good time to be buying Visa, and dollar cost averaging down. Now, the lowest Visa has traded at over the last 10 years was 20 times earnings, and this was at the COVID bottom. So I personally agree. Like, I agree with the bearish people. I mean, they think Visa should be trading at 20 times. I agree. But the likelihood of this happening is very, very low. Unless you're betting on another COVID crash, which would be amazing, but the likelihood is very low. For you to get an amazing company like Visa at 20 times earnings. So I believe 25 times earnings is not a ripoff. I think it's trading pretty close to fair value for a company that has 56% net income margins. Very high net income margins. For a company that has earnings per share, it's still growing double digits. 13%, 12, 13%. And I agree with the 13% estimate, 13 to 15%. Pretty amazing stuff. And by the way, if you believe we're going to have more inflation in the future, Visa is the best hedge against inflation because they take the transaction fee. If things get more expensive, they're going to still get, let's say, the 1.5% transaction fee, but it's going to be 1.5% of a higher amount if prices went up. So this is an automatic hedge against inflation. If you believe we're going to have more inflation, that's bullish for Visa and MasterCard's earnings, and they're still growing earnings per share 13%. Not bad at all. The company has a lot of free cash flow. They can't really do mergers and acquisitions without being hit by antitrust lawsuit. It's getting very difficult. Amazon couldn't even acquire iRobot because of the antitrust. So it's very strict recently. And all they could do is return it to shareholders. Invest in organic growth, of course, but then do buybacks and dividends. And they do buybacks. They buy back 2.5% of the market cap on average every single year. And the company does have a dividend. The dividend is not even 1%, but it's rapidly growing. It was 5 cents in 2008. Now it's $2.08. That's really, really good. So for me personally, looking at all that stuff, high return on capital, high net income margins, 56%, 13, 14% earnings per share growth for 25 times earnings is not a ripoff. It's not bad at all, especially if you compare it to other opportunities in the market, other companies with large moats. They're not even growing revenues. And Visa is still growing, is going to continue growing. I love the company, big fan, loves the business model. I think Visa right now is getting pretty close to fair value. And I would prefer it at 22 times, 23 times, but 25 times is not a ripoff. So I don't think it's a bad time to be buying Visa and dollar cost averaging down. It's not financial advice, of course. It's just my opinion. And Visa, in my opinion, is a quality company that's trading pretty close to fair value. Another stock that I believe is a quality company trading at fair value is McDonald's stock. McDonald's is down 14% year to date. You don't see it very often. I remember looking at McDonald's, and it just keeps going up. I look at it, it keeps going up. Now it's pulling back, and you don't get it very often. But always, whenever you have such pullbacks, you get all kind of reasons why you shouldn't be buying it. It's a mature company, the growth is over, and all that stuff. And then, after you look at it a few months later, you look back after the stock went up in hindsight, and you're like, oh, that was a good opportunity. But that's how bottoms are. That's the best time to be buying them, is when you're hit with all kind of reasons why you shouldn't be buying them. This is normally the best time to be buying them. And I really like McDonald's over here. I don't own it yet. I own Pepsi. I did disclose that. But I'm still looking into McDonald's. I really like it. Most of you know their franchise business model. It was 80% in 2013. Now it's 95%. And it's very high margin stuff. Pretty good. They are planning to increase the restaurants by 50,000 restaurants by 2027 in the United States and in other places around the world. And that's very good for McDonald's. I'm not going to do a deep dive because I did before. If you look at where McDonald's is trading at right now, it's trading at 20 times earnings, which has been historically a good time to be buying McDonald's stock. The mean was 23 times. It traded as high as 35 times earnings. Now it's trading at 20 times earnings. The lowest it has traded at was 16 times, and this was in March 2020. I don't think we're going there anytime soon. 20 times earnings is a fair multiple for a company that still has over 33% net income margins, very high net income margin. They're still buying back stocks. They buy back 1 to 2% of the market cap most of the time. I believe it's 1.5 to 2%. So very good. And you're also getting a dividend. It's not the highest dividend ever. It's 2.5%. But the way I think of McDonald's, I think McDonald's right now is in a rough patch, I should say. There's a lot of uncertainties, a lot of business pulling back internationally. But I believe this is temporary and it's not going to last forever. And a company like McDonald's is eventually going to come out of it. They're taking initiatives, $5 meal and other things. I don't know how profitable this is going to be, but I just see, a good opportunity in McDonald's. It grew 38% earnings per share in 2023. This is unsustainable, of course. I believe over the long term, it's going to be 8 to 9%, just like Pepsi. I think it's very fair. So if I take a 9%, let's say on average, earnings per share growth, and I'm getting a 2.5% dividend. I mean, this is pretty close to an 11.5, 12% return every single year over the next 5 years, excluding a multiple expansion from 20 to 23 times. McDonald's is not the cheapest stock in the world, and that's why I said before, to me, if I would buy McDonald's, it's more of a shorter term investment. You know, I do things based on sentiment, and then you have rotation out of AI into safety, the recession narrative. People start buying McDonald's, it goes up 50, 60% in a few weeks or in a month or two. And that's when I get out. That's how I think of McDonald's. Visa is an amazing company for the long term. So maybe McDonald's is a little bit more of a slow grower. But if you're a dividend investor or you do some things for the short term, I think McDonald's is not a bad company at this price for the net income margin and the bad sentiment around it. 20 times earnings is not expensive at all. And this is not financial advice, just my opinion on Visa and McDonald's. I really hope you enjoyed this video. If you did, please press the like button and let me know what you think in the comments. So I'll talk to you in another update.